Historically, governments counter economic crises with a mix of monetary easing, fiscal stimulus, and regulatory reforms. Examples include lowering interest rates and buying securities to add liquidity, alongside tax cuts and increased public spending to bolster demand. For instance, during the COVID-19 pandemic, the U.S. enacted the CARES Act, providing direct financial relief and expanded unemployment benefits, while the Federal Reserve took aggressive steps to stabilize the market. Such actions aim to stabilize the economy and stimulate spending, though they may lead to higher national debt and inflation risks. Regulatory reforms typically follow significant downturns, influencing both policy direction and public sentiment. So in the last segment, Caleb brought up the great point that there are many things to worry about. There's always a wall of worry, but there's an opportunity cost if you're not invested and a bear market, in fact, doesn't come. And right now, we've been waiting for this economy for even a recession to come. It's been very elusive. Chris, how should individual investors respond to government interventions like monetary easing or fiscal stimulus during an economic crisis?
Yeah, I mean, for the individual investor, I mean, I feel like investors in general, a lot of them were counting on the Fed in recent years to bail them out in terms of whenever there is a crisis or there's a recession. So it's a question long term of, can the Fed keep on doing this time and again? And I think after the great financial crisis, they had driven their balance sheet up to unprecedented levels, providing quantitative easing. It's just how much ammunition do they have each time around? This time they have raised interest rates, so they could cut the next recession. We'll see what they have left in their arsenal when a recession comes over and over. But I think that investors in general just are counting on the Fed put in bailing them out, and eventually that would run out.
Caleb?
I don't see how they don't but bail out whatever happens next time. This is a moral hazard that they've now decided that this is the way that they are going to act. And you can think about, Ben Bernanke, who did this, who was a student of the Depression. He knew that if they had just thrown that helicopter money down onto the economy, it wouldn't have lasted as long, and it wouldn't have been as severe. So he brought that to bear during the great financial crisis. And that was the solution in terms of getting the economy out of the rut. It worked. It did blow open some parts of the economy and created some broader income separation between people, right? More income inequality. The shareholder class got richer. The asset owners got richer. And we saw it again during this COVID crisis too, right? Helicopter money. Shareholders got a lot wealthier. Homeowners got a lot wealthier. That class of people did well, but the split between the haves and the have-nots just gets more and more divided. But there is no other solution from a monetary policy point of view other than to pour money on it, because nothing else actually works without doing greater damage, especially to lower income people.
Caleb, are there any critical lessons that the financial media have learned from covering government responses to economic crises?
Yeah, I mean, and that took me a lot of lessons. I cut my teeth during the internet bubble, lost a lot of money, but also learned a lot as a journalist. And then during the great financial crisis, you have to assume that anything can happen, right? The thing that you don't think can happen can easily happen. Who would have thought a pandemic would have shut down the global economy basically overnight, right? Who would have thought that Lehman Brothers, a 108-year-old financial institution, would go under, and that the Fed would allow that to happen? So anything is possible. And I think as business journalists, we get used to the things just working out the way they used to work out in the past. Anything can happen, and we should just expect the unexpected and be prepared to ask tough questions when things are happening.
Yeah, no kidding. I mean, it was incredible watching the news coverage of Lehman employees carrying out their desk belongings in boxes. Unbelievable. Yeah. Gary, how have past government interventions affected the investment landscape for individual investors? And how do you incorporate these interventions in your research?
That's a great question, and I think the topic that keeps coming up is moral hazard, and that's what we keep seeing, right? The government, by bailing people out again and again, creates an incentive to take inappropriate risk, and we're seeing that constantly. And so, one of the things that we've been talking about a lot in our weekly piece, the 5 things to know in investing, this week, is we've been talking a lot about commercial real estate, and people are telling me, well, we don't think it'll be as bad as 2008. And I actually agree with that. There's less leverage in the system right now. And that part makes sense. But I'm already hearing credible rumors that Washington is preparing another bailout. And, capitalism without failure is not capitalism. We are basic. And it's not, by the way, it's not just corporations. It's not just the stock market. We're seeing it on an individual basis as well, right? We're going to have debt forgiveness for this and debt forgiveness for that and student loan bailouts. And by the way, I would love for people to stop using the term debt forgiveness. The debt is not being forgiven, it's being transferred. It's being transferred from people who took that debt on to people who didn't. And whether it's student loans or corporations or another bank bailout or a commercial real estate bailout, those are the kinds of things that we see again and again. And when that happens, there's an expectation. So, one of the reasons why people are comfortable owning huge positions in banks right now is because they feel like if the banks have great returns, they take risk and it works out well, terrific, they'll get paid. If they don't, the government will backstop them because it would be terrible to have banks fail. And what the government is great at doing is blowing up ever larger asset bubbles. And that's what we keep seeing. And that's why the amplitude of these crises keeps getting worse and worse, because we just print more money, we bail out people more. It blows up another giant asset bubble. The Fed did it by keeping interest rates at zero for more than a decade and having a $9 trillion balance sheet. So that's their answer to all of this. And, we talked about Bernanke, we talked about the Fed put. That's what people are expecting. There is this incorrect assumption that everything will always be okay because Big Daddy government will make it so.
Let's go to segment 3.